The buy and hold strategy involves purchasing properties to rent out and hold for appreciation, generating steady income over time. Like the fix and flip strategy, it may not be for everyone. Let's review its pros and cons. One of the primary benefits of buy and hold investing is the ability to generate consistent cash flow through rental income. This steady stream of income can help cover mortgage payments, property maintenance, and other expenses, providing financial stability and ongoing revenue. Buy and hold properties appreciate over time, potentially increasing your net worth as property values rise. This strategy allows investors to build equity gradually, which can be leveraged for future investments or to fund retirement. Rental property investors benefit from various tax deductions, including mortgage interest, property taxes, repairs, depreciation, and operating expenses. These deductions can significantly reduce taxable income, boosting overall profitability. Finally, real estate often acts as a hedge against inflation. As inflation rises, property values and rental incomes tend to increase, helping preserve purchasing power over time. While being a landlord involves responsibilities such as tenant management and maintenance, buy and hold investors often adopt a more hands-off approach compared to the intensive renovation process of flipping. This can be appealing to those seeking a more passive income stream. Long-term investors can enhance property value through strategic improvements or better management, increasing rental income and property value over time. Finally, folding properties long-term minimizes the risks associated with short-term market fluctuations. Over extended periods, property markets tend to trend upward, offering a degree of stability and capital preservation. Let's now look at the disadvantages of this strategy. Unlike fix and flip investments, buy and hold properties typically appreciate gradually over the course of many years. This slow pace of wealth accumulation may not align with investors seeking rapid profits or those needing liquidity in the short term. Another downside involves handling the day-to-day activities. Being a landlord involves ongoing responsibilities, including collecting rent, handling repairs, addressing tenant issues, and ensuring compliance with housing regulations. These tasks can be time-consuming and sometimes stressful, especially if properties are located far from the investor's primary residence. Next, rental properties are subject to periods of vacancy during which no rental income is generated. Extended vacancies can strain cash flow, primarily if the investor relies heavily on rental income to cover mortgage payments and expenses. While real estate generally appreciates over the long term, market downturns or economic recessions can temporarily or permanently reduce property values. Rental demand can also decline in economic downturns, affecting income stability. Setting aside this issue, the initial investment can be staggering. Buying and maintaining rental properties requires significant initial capital for down payments, closing costs, and ongoing expenses. Moreover, real estate is relatively illiquid compared to stocks or bonds, making it challenging to access cash quickly if needed. As with everything, costs such as property taxes, insurance, maintenance, and property management fees tend to increase. These rising expenses may reduce net rental income unless rental rates are adjusted accordingly. Another major concern is navigating local landlord-tenant laws. Fair housing regulations and legal requirements can be complex and vary from jurisdiction to jurisdiction. Non-compliance can result in legal issues, fines, or loss of rental income. Please check out our course on rent caps, just cause evictions, and security deposits. It contains a more thorough discussion of this issue. Finally, older properties often require regular updates and repairs to remain competitive. Technological and design standards evolve, making some properties less attractive over time, which can impact rental income and appreciation potential. So, what should I do? Choosing between fix and flip and buy and hold depends on your financial goals, risk appetite, and experience. If you seek quick profits and are comfortable managing renovation projects, fix and flip may suit you. If you prefer a steady income and long-term wealth building, a buy and hold strategy may be a better option. Both strategies can be profitable if executed correctly, but they demand different skill sets and risk management approaches. Many successful investors incorporate both strategies into their portfolio, balancing short-term flips with long-term rentals. If you're starting, consider your investment horizon, available capital, and experience level before selecting a strategy. Whatever you decide, diligent analysis and a thorough understanding of the market are key to maximizing your investment success. Please consider taking our course on real estate investing for your future. That course offers an examination of various topics related to investing in real estate for your future.